Welcome to Talk Tickers. Today, we're digging into Palmer Square Capital, BDC, ticker PSBD. Their third quarter earnings just dropped, and honestly, it's a bit of a head-scratcher. We're seeing this really bizarre disconnect between how the company is actually doing and what its stock price is telling us.
And yeah, this is the big puzzle, right? I mean, on the one hand, they delivered a solid quarter, beating what the analysts expected. But then you look at the chart, and the stock has been absolutely brutalized, down a whopping 24% over the past year. So what gives? What is the market seeing that maybe management is missing? That's what we're going to decode. All right, so first up, let's get into the nitty-gritty of the quarter itself, the actual numbers, because this is really where that contrast between solid execution and a terrible market reaction just screams at you. Okay, so take a look at the scorecard here. It's pretty clear they outperformed. You've got net investment income, or NII, which, is the key earnings metric for a business development company, coming in at 43 cents a share. That's a nice little beat over the 41-cent consensus. Revenue also came in hot, almost 4% better than Wall Street was looking for. Now, it wasn't a perfect report card. There was one blemish. The net asset value per share, their NAV, did dip a little bit, which kind of hints there might be some pressure on their loan book. But let's just double-click on that net investment income beat for a second. That 2-cent beat, it might not sound like a lot, but it is absolutely crucial. And here's why. Because that 43 cents in earnings fully covers their total quarterly dividend of 42 cents. If you're an income investor, you know that is a massive green flag. And you can bet management was hammering this point home on their earnings call. And yet, here we are, right back to the core problem. The stock is trading at a huge 23% discount to its net asset value. Let that sink in for a minute. The market is basically saying that the company's entire portfolio of loans is only worth about 77 cents on the dollar. So you've got this healthy income statement on one side, but the valuation is just screaming total and complete skepticism. So you can imagine, with a disconnect like that, management had to come out swinging. They spent a ton of time on the earnings call trying to convince investors that the market just has it plain wrong. Let's walk through their side of the story. And they were not mincing words. The chairman and CEO, Chris Long, came right out and said it directly. He believes their stock is fundamentally undervalued. Pretty direct. So what's the evidence they're using to back that up? Well, their bull case really boils down to a few key arguments. First, like we saw, the dividend is safe. It's fully covered by what they're earning. Check. Second, they're putting their money where their mouth is with a new $5 million share buyback program. It's a smart move when your stock is this cheap. Third, they're saying, hey, look at our credit quality. The bad loans, what they call non-accruals, are at a tiny 0.4%. And on top of all that, they're the only BDC out there that gives you a new NAV number every single month. Total transparency. That's a pretty compelling case from the C-suite. It makes a lot of sense. But the market gets a vote too. And its vote so far has been a loud, clear nope. So let's flip the script and look at the market's rebuttal. Wow. I mean, this chart says it all, doesn't it? It's one thing to be lagging the S&P 500, but what's really damning here is how badly they are getting beaten by their own peers. The main BDC sector ETF is basically flat over the last year. PSBD, down more than 24%. When you see a performance gap that wide, it tells you investors are worried about something specific to this company. So let's just lay it all out, side by side. You've got management's view versus what the market seems to be saying. Management says, those credit problems you're hearing about elsewhere, they're one-offs, not our problem. The market is saying, we're terrified of a systemic blow-up in private credit. Management says, our portfolio is strong and resilient. The market just points to the stock chart. And finally, management says the stock is a huge bargain. The market's response is to just keep that 23% discount right where it is. Thank you very much. So why is the market so spooked? Well, to really get it, we have to zoom out. This isn't just about PSBD. There is a hurricane hitting the entire BDC sector right now. It's that classic saying, location, location, location. PSBD might be a decent house, but it's in a really stormy neighborhood. Just look at the timeline of bad news that hit right before this earnings report. In September, the Fed starts cutting rates. That's generally bad for future BDC earnings. Then, boom, October hits. JP Morgan downgrades them. Then UBS downgrades them. Then the headlines start popping up about a big BDC meltdown. And just to add fuel to the fire, an insider sale gets reported. I mean, for any investor, that is a massive wall of worry to climb. And right in the middle of all that panic, it's so important we understand this one term, non-accrual. It's just a fancier way of saying a loan has gone bad. It's not paying anymore. This is the key health metric for any lender. And this is where the story gets so weird for PSBD. Because while the world is panicking, their non-accrual rate is just 0.40%. That's ridiculously low. It tells you that whatever is happening out there, their own loan book is actually holding up incredibly well.
Okay, so let's recap. We've got strong company fundamentals, we've got brutal market technicals, we have management's bullish story, and the market's complete rejection of it. So what do we do with all this? It's time for our final analysis, the next call. We're going to break this down into 3 simple parts. 1, our forecasts for their next earnings report. 2, our prediction for the stock price. And 3, our final equity research style rating on the stock. All right, so for Q4 earnings, we're basically expecting a repeat performance. That income should keep chugging along enough to cover that all-important dividend, but their net asset value is probably going to feel some more pressure from all the market volatility. Now, as for the stock itself, it just feels stuck in the mud. That massive 23% discount should act as a pretty solid floor. It's hard to see it falling much further. But for it to actually go up and close that gap, the entire BDC sector needs a big sentiment shift. This stock is basically a hostage to the bigger macro story.
So that brings us to the bottom line, our final rating. We're officially calling PSBD a market performer. Now, that doesn't mean sell, but it is definitely not a screaming buy either. What it reflects is a company with solid, well-managed fundamentals that is just trapped by a deeply negative cloud over its entire sector. Until those headwinds clear, it's really tough to see this stock outperforming. It is the classic case of a good house in a bad neighborhood. And the big question for investors is, when do you bet on the house versus waiting for the whole neighborhood to get better?
This is not financial advice.